Okay, so we'll start with the next session on the objective of SA 540. Okay, before we proceed, we'll have a quick recap of what we had studied. Let me just put it up. Okay, so we had started in the previous session in SA 540. Okay, first we started with the scope. Okay, and then we started with certain basic concepts about the nature of accounting estimates. So when we talk about the nature of the estimates, we spoke about what it is. It is an item which cannot be precisely measured. Then why auditor is concerned with it? Because of the ROMM. Now, what necessitates? Why there is a necessity to create? Either because of the business activity complexity, uncertainty in the business activity, characteristics of the item, or because of the financial reporting framework. It could have asked you. Then we learned about the different examples. So primarily it is fair value estimates, other than fair value estimates. So we have seen the examples of that. Then came the estimation uncertainty. So estimation uncertainty means you will not be able to precisely measure. There will be a vast big difference, and it is a significant risk for you. Now, why it varies from entity to entity? Because of the nature of the estimate, what you are estimating, whether generally accepted methods are there, and subjectivity in the assumptions, because assumptions are inherent. Then they gave you two reasons, like what is the reason your estimates will be low for some of the estimates, and give me some examples where estimation uncertainty is very high. Then we discussed about those reasons, 5 reasons, and some 4 or 5 examples. Okay, then the element came about the management bias, okay, which is like lack of neutrality. Now it is very difficult to detect that neutrality, lack of neutrality at the account level, but when you aggregate, like for example, you call somebody as a judge for some competition. Now what do you generally expect? That judge should be very neutral. Now knowingly or unknowingly, that person may have some favoritism for someone. Now, with one instance, it becomes very difficult. So, when you consider all the judgments given by that judge in a day, or all the judgments over a period of time, you will suddenly realize that the judge is a bit biased. That means he is favoring for one type of person or one category of people. So, this will get reflected only when you accumulate on a larger set of data. So it is very difficult to detect at the account level. So you need to identify the management bias in the estimates. Like management is taking 6% attrition rate instead of 8% what industry is taking. Their depreciation is at a life they are considering it a high value. Defined benefit obligation they are making low provision. See, one instance may not tell, but when you see everywhere they are trying to inflate the profit, whether they are knowing about it or not knowing about it, that is secondary story, but you can identify one sort of bias. So this is all about your management bias. Okay, so the next one, today we will start with the objective of SA 540 and its requirement. Now SA 540 has got two objectives. First of all, auditor has to obtain sufficient appropriate evidence. That means he has to perform some procedures. Whether accounting estimates, including fair value estimates, are reasonable. Like we have seen experts work, whether findings are reasonable, assumptions are reasonable. Okay, similarly, we have to see whatever estimates the management has made, they are reasonable. Second, all the related disclosures which is required to be done by related to that, because the moment estimates come into picture, disclosure has to be given, like what assumptions you have taken, okay, how much uncertainty is there in that estimation. Now, have you given adequate disclosure? Because not giving that adequate disclosure itself is misstatement. Because you have made an estimate and you are not giving the basis of that estimate. That is literally misguiding. So, we have got two objectives. Now, some important definitions they give. What is an accounting estimate? Approximation of monetary amount. So, we learned that it is a financial statement item and in the absence of precise means of measurement. Okay, it is an approximation of the monetary amount. Means financial statement item. Auditor's point estimate or auditor's range. I told you, when the management is making one estimate, to justify that, auditor also can independently do that estimate using himself or using the work of an expert. Or he can create a range. Yesterday we discussed about that portrait. That value can be 4.8 lakhs or 4.5 to 5.5, a range. So similarly, auditor also may define a range to decide the reasonableness. Management bias means lack of neutrality. Management's point of estimate. See, management cannot have a range. Please understand. Auditor can have a range. So when the management is trying to make an estimate, okay, whether they are able to precisely measure or not, their estimation should be always point estimate, because they have to pass the journal entry. They cannot say the value depreciation is 4.5 crore to 5.5 crore. Then what value they are going to pass the journal entry then? So, but auditor can develop. Why? Because auditor works with the materiality. Because auditor cannot precisely calculate it. But they have to do. Now, estimation uncertainty is susceptibility of an accounting estimate or and related disclosure to inherent lack of precision in its measurement. Okay, so when it lacks precise measurements, it's called estimation uncertainty. So when you are not able to measure it precisely, there are chances that the reality could be actually different from the expectations. Okay, we'll move on because there is nothing much here you need to focus. Outcome of an accounting estimate means actual monetary MO, which results from the resolution of underlying transaction events addressed by the estimate. Okay, so there should not be much gap between actuals and the expectations. Now, how many requirements are there? Okay, let us make a mind map at the same time. Objective. Okay, we will write the objective of SA 540. So, primarily we have got two objectives. Obtain SAAE, that estimates are reasonable. Estimates are reasonable. Second, management has done all the disclosures. All the disclosures are adequate. These are all the two. So how many requirements are there? Okay, we can say there are 7 requirements if I have to fulfill. 1, the first requirement. Okay, we already discussed. This is in line with SA 315 and 330. So SA 315 also starts with the identifying the risk. How? By performing risk assessment procedures. Okay, what does this risk assessment procedures include? We will see that later. What exactly you need to check when it comes to procedure, when it comes to estimates. The second step involved here, if you want to fulfill this objective, you need to identify and assess ROMM, risk of material misstatement. So once you have, how do you do risk assessment? What are your risk assessment procedures? Inquiry, observation. Okay, why you do it? Like to understand entity, environment, the management's internal control. So this is more like study. Second step is to identify and assess the risk. When you identify, assessment means whether overall level or assertion level. The third element, after you identify, because this up to this it is 315, respond to assessed risk. This is your 330. Respond to the risk. Yeah, I will tell you in the study material, they will make you a bit confused. And after you respond, means you perform either test of controls or substantive procedures, you will get evidence. Evaluate reasonableness. Yeah, because after you have responded, after you have performed the procedures, you would have got an evidence. No? You please check whether they are reasonable. And the fifth one, reporting and disclosure. You need to check whether the management has appropriately disclosed? If not, what type of opinion you need to obtain? Sixth one, you need to obtain written representation because you don't have any other evidence with regard to estimates. And the last one, you need to do documentation. Yeah, maybe 2 marks they can ask you this documentation also. The last step is to do documentation. So now our every discussion will revolve around this. Out of this identify and assessment of the risk, already we have discussed estimation uncertainty. Okay, and this is very important. The first one is very important. Other things are a bit fine. Okay, now let us go and try to understand. Let us write the first point. First point here, risk assessment procedures. Risk assessment procedures. Okay, so what is that auditor need to understand? What is a risk assessment procedure? It is a procedure to identify the risk, like you do the inquiry, observation, inspection, etc. So, when you are performing risk assessment procedure, the very first thing you need to understand financial reporting framework, because your financial reporting framework has got a fundamental effect on the estimates, because a lot of the estimates comes because of your financial reporting framework only. Like for example, accounting standard. Under accounting standard, no, there was no much fair valuation. But the moment you have shifted yourself into Ind AS, you find that almost every standard fair valuation is applicable. That means the need for estimation has skyrocketed. Now you happen to be a bank. Lot of RBI regulations will come. You estimate this, you check that. So your financial reporting framework primarily contributes for your estimates. So first thing is you need to understand what the financial reporting framework says. Second element, I can say, you need to understand how management identify events. You go and ask them only, no, because we have seen what necessitates your financial estimates. One of the reason management has to make estimate because of the uncertainty in the business activity. Like management has to give warranty. Management gives promise that we will give you retirement benefits. Management has earned taxes in a place where tax is applicable, not in Mauritius and all. Okay, managements after consuming some product, somebody has got ill and they have filed a complaint against the organization. Now, ultimately, your business is contributing. So management is doing the business. You ask them, how do you identify the business? How do you identify the events which is going to create? Like last year, they had not given assurance warranty, but this time they have given assurance warranty. So now new additional provision has to be made. And then how they make the estimate? Okay, first of all, how they identify that they have to make. And what is the process they will make the estimate? How they will make? Like what type of internal control do exist? How do they do the calculation? Which method of estimation they have selected? What assumptions they will take? Okay, if there is an estimation uncertainty, how do you address? You ask the management only. Maybe I can ask you, okay, like, okay, did I tell you to give this, to give an analogy? When you have written a test, you are supposed to give me estimated marks. Out of 50, how much do you score for MCQ and descriptive? Okay, see, if you other places you may not be doing, but with me you should do it because it is a reporting framework for you. Now, how do you identify that event? Okay, the moment you are written the test, you have to do it. How do you make it? What is your method? Okay, do you go back to the study material and verify it, how much you may score, or you are writing just gut feeling? I want you to just write the gut feeling. Don't go back and check the answer and then say how much I am going to get. I don't want that. You only your gut feeling, you feel how much you are going to get. That's what I want you to enter. And the last one, evaluate prior period estimates. Okay. Now, what is the concept of a prior period estimate? See, I need to go back and ask management, Okay, show me last year's estimates. Now why? Because I don't want to find an evidence, find a fault. So in 2024-25, they have made a tax provision. Now this tax provision, when it will get finalized? In the year 2025-26. So this year I have come. Okay, I am on 31st March 2026 now. Now, if I can get the tax provision, what they have done last year, and what assessment of audit or assessment order came, I can just compare it and I can see how good they are in making estimates. Like they have made a warranty provision. This time, actual warranty cost came. So, whether their warranty provision, their estimations and reality, do they match, or there is a sky and that land difference? So, there is a very difference, big difference. Like you made a provision for 10 crore and the actual expenses happen to be 90 crore. That means this time you have to be extremely careful because you cannot trust the management. Their management processes are not strong. You cannot accept that estimation where you find a very big difference between what they are expecting and what is the reality. That's why the fourth step is to go back and check last year provisions and see whether those, when the actual values have come, are they matching with the last year provision. So these are all the four elements you have to consider under risk assessment. I hope it's clear. Very important. And they can ask you questions on this. Now, the first thing, we'll go through the study material. They say that you have to perform risk assessment procedures. So, when you are performing SA 315, auditor shall obtain an understanding of following thing. One, which reporting framework is applicable? Very important, because as I told you, lot of estimates are coming just because of one financial reporting framework. Second, how do you identify events and conditions that gives rise? Like what is your internal mechanism? Like suppose somebody has filed a case against you. How do you know that somebody has filed and should I make a provision or not? This is what you need to understand. For this, no, you have to make inquiries of the management about the change in the circumstances. Okay, sir, have you changed the circumstances? Have you come with a new product? Have you changed your marketing plans? Have you given a new offer to your employees? Now, how obtaining understanding of how management identifies the need for estimate. So management is ultimately responsible and they are supposed to make. Okay. So inquiries of the management, very important, mark it important. What is that you are going to inquire with the management, asking changes in the circumstance? For example, have you entered into new type of transactions? Okay. Because if you have entered into a very new type of transaction, you are totally new to this transaction, like new contract. So tomorrow it can happen that this contract may turn out to be onerous contract. What is an onerous contract? Okay, for this you have to go back to Ind AS, which says that any contract you enter with the expectation that you are going to get cash more than what outflow is going to happen. But in case of an onerous contract, the present value of the benefits of what you are going to get is less than what amount you are going to spend to fulfill the contract. That means by default it is lost to you. Given a choice, you could have come out. So the Ind AS says the moment you figure out an onerous contract, you are supposed to make provisions because it's a loss for you. What amount to be done, that Ind AS will speak. But this is the inquiry you have to ask, sir, have you entered into any new type of transaction because of which estimates have to be made? Like for example, in Airtel, is there any debtor? Okay, maybe I can say, okay, best I'll come talk about the insurance companies. But then insurance companies will have debtor. No, why? Because without paying premium, your insurance will never start. So they don't have any debtors in their financial statement. But they entered into a new type of transaction where the debtor got created. Imagine they have given a loan, which they never did. First time they have given a loan. Since they have given a loan, there can be a provision for bad debts. So new type of transaction has resulted into estimate. You have to ask management. Now terms of transaction that gives rise to accounting estimates have been changed. Have you changed the terms of transaction? Like have you made a provision that you will compensate them? Initial terms of transactions there was no compensation clause, but there was an amendment in the clause. Then also estimates come into picture. Have you changed your accounting policies because of the applicable reporting framework? Like that's what I told, no? AS to Ind AS. So no, you have to change your accounting policy. Last time you are measuring at cost, but this time you have to measure at a fair value. Is there any regulatory or other changes outside the control of the management which requires to make new estimates? Like government has come with the rule and they said, okay, you have to make so much of provision for, say, decommissioning. Best example I can say. Maybe once upon a time, there was like you set up a plant and one fine day you walk away from there, no problem. But today there are very strict regulations. Imagine the day first time the Industrial Act or whichever came and asked for site restoration. That means, like for example, MRPL, they have come and set up the place. They are going to process the oil. After 20 years, they are going to leave this place. And they cannot just walk away, right? They have to clean the site. There are a lot of environmental implications. So you have to make a provision for decommissioning liability. And when you start making, only when there are strict regulations related to that. Say for example, so something like this, when it comes, you may have to make or any new condition or events that can give rise to new or revised accounting estimates. Like for example, impairment happens, okay, or your new competitor comes and your value of the goodwill falls. Impairment is also an estimation now. So is there any new events or condition happen? I hope students you are clear. The first step is for you to understand about the financial reporting framework and how management will identify. So what are the questions you are going to ask? Have you any new transaction, change in the terms, change in the policies because FRF change, regulatory changes, new conditions or events, etc. The auditor may identify certain transactions that need accounting estimate, which the management has failed to understand. This is problem. First of all, estimate is the responsibility of the management. They were supposed to do. Okay, they didn't do. Auditor found out. Then that means they have really failed to perform their duty. And for us, it is significant deficiency in the internal control. So when we are performing risk assessment, we have to keep this in mind. That means when there is a change in the condition, management didn't knew that we have to make an estimate. Auditor only advised. This is the problem. I hope it's clear. The next thing is, you need to understand how management is making the estimates. Like what is the method they follow? Do they use discounted cash flow method, or do they dividend discount model or any other model? Now, what type of controls do they have on these calculations? Have they used any experts, whom we call management expert? What type of assumptions they have taken while creating an estimate? Assumptions means expecting that everything is fine. Whether there have been any change from the period in the methods, like last year you followed FIFO method, this time you have shifted to weighted average method. Is there any changes? And whether how management has assessed the estimation uncertainty. So these are all the factors you need to understand when you understand how management is making. Please understand, this point is different from the previous point. In the previous point, you have to ask management, sir, how do you understand that you have to make provision? And in this case, you ask them how you are actually making provision. Show me your methods. Are you doing it internally or have you outsourced it? Okay, what type of internal control exists? Have you appointed any expert? Okay, is there any estimation uncertainty? This type of questions you should be asking. And the last element, you need to review the outcome of accounting estimates of the 3-year period. Why? Because I already told you, last time they made estimate, this time they are there, you are there. So you can clearly see what is the gap between last year estimates and the last year actual results. So if the gap is huge, then you may not trust the estimates done by the management this year. Instead, you may do it yourself or may call one expert. So whether the information obtained from the review would be relevant to identifying ROMM, accounting estimates made in the current year, not intended to, okay, and this is what you're going to test. So your objective is not intended to call the judgments of the paper. You don't argue with them, sir, you are not good and all. Because see, the estimation depends upon the available information. So at that point of time, whatever decision they have taken is the best decision. But at least you will come to know what is the basis for the decision. Have they missed anything out? What their assumptions reasonable? I hope it's clear, student. Yes, let us see some 3 examination questions which could have come on this. Now, test your knowledge one question. I have marked it as a priority question. In fact, this question has previously repeated so many times in MTPs. While auditing Z Limited, you observe certain material financial statement assertions have been based on the estimates. This is the keyword. From this, you figure out SA 540, they must be asking. How do you minimize The risk of misstatement. You see the beautiful question. How you are going to minimize the risk of material misstatements now? For this, no, you need to understand risk of material misstatement is in the control management and the auditor cannot minimize. Okay, you see, how do you minimize the risk of misstatements? ROMM, it is in whose control? Who can control this? You see the question, see the beauty of the question. Because when you talk about what auditor is supposed to do, auditor is supposed to express opinion. So audit risk is nothing but a combination of ROMM and detection risk. Now, risk of misstatement, who can control? Management can control. How? By establishing internal controls. Now, can auditor control or minimize the risk of misstatement? No. But you see the examination question. They're asking how auditor would, as an auditor, how do you minimize the risk of misstatement? You can do only detection risk by performing substantive procedures. That's it. Okay. Only management can do it with the help of controls. So what an auditor can do, he can identify and assess the risk of misstatement. He cannot minimize the risk of misstatement. Have you understood, friends? Did you see here how they will ask the questions? We can understand the question as an auditor, how do you identify the risk of misstatement? Let us make an interpretation like that. No. Because this can be a wrong question. This is the wrong word. They should not tell like that. So can they ask us like, okay, or alternative perspective is, how do you see that the risk of misstatement is low or risk of misstatement is minimum? The only thing I can do is to identify and assess the ROMM. Okay, how? This is what you are going to write. So first we will understand the reporting framework, how management is going to identify. For this we are going to make the inquiry and we will understand the estimation process like methods, controls, experts, etc. And we will review the prepared estimate. I hope it's clear, students. So this is what you are going to tell. Now CA Raj has been appointed as an auditor of a real estate company. He requested information from the management to review the outcome of accounting estimates. See, this is the keyword. So you understood it is 540. Such as estimated cost considered for the percentage of completion used in the prior period. Now 540 you are clear. There are 7 requirements. Now which one they must be talking about? They are talking about the first requirement because the keyword again is the prior period estimate. That means this auditor is asking, sir, please give me last year's estimate. Now, why he asked that last year estimate? He wanted to assess subsequent re-estimation in the current period because actually he knows now. But the management refused. They said, why you want? Arey Baba, you are the auditor this year. When you came as an auditor, what did we promise? We will give you relevant information and all. Are you signing this year's financials or last year financials? So why do you want last year's financials? That is already audited. So they started to argue with the auditor that you should not review the period to estimate, advise how you should deal with the situation. Yes, so they asked you to advise, not to comment whether who is correct, who is not correct here. So your advice is, look, you have to explain management that you have got an objective. Objective is to see whether the estimates are reasonable and disclosures are adequate. In order to check whether estimates are reasonable, my first job is to perform risk assessment procedure, which includes 4 elements. Understanding of the framework, understanding how management will identify, understanding the management processes, and review of the last. And you have to stress more on this last point. And you have to say that my primary objective is not to identify and not to blame you, but my primary objective is to check what is the process of your making the estimates. Gamma is in the construction business. The auditor understands that through construction, estimate is vital. See, estimate keyword. And requested the information of the financial operations to review the outcome of the estimates in the pre-period. See, keywords. The management refused to provide, believed that the judgments of estimates made in the period were based on the information available at that time, and review of it should not be done by the auditor of the current period with reference to the relevant standard. Okay, here you have to quote SA 540. Comment. Please understand whether management is correct or not. See, in this question, you need not comment. You need not tell management is not correct. No, you may tell it, but you will not fetch any marks because the word is advice. So you need to advise him like how to proceed. But here you have to tell whether the management is okay or not okay. Now first you start here and you're going to write all those 4 points. Evidence about the okay, here primarily you will focus on that fourth point. Outcome of an accounting estimate offer differ from the previous period. The information regarding the effectiveness of the previous period estimation process. Auditor is likely effectiveness of the current, because from the previous period you will check effectiveness of the current period. The audit evidence that is pertinent to the re-estimation, audit evidence of the matter such as estimation uncertainty may be required to be disclosed. Okay, so your objective is not to find the fault, but to just check whether your estimation processes are okay. However, review is not intended to call the question, so management is not correct in the given case. Okay, so this is a very nice question. You can consider to mark as a priority if you want. Okay, so we'll see the third question. A private is in the engage of real estate business. Auditor requested the company to review the accounting estimate included in the prior period. The management refused the information, saying that they should not be done by the auditor. Please advise or comment. Okay, similar question. Okay, so here you can start explaining as per SA 540. You can write the objective. Okay, auditor shall review the outcome of prepared financial statement where applicable subsequently for the purpose of the current period. The nature and extent of the review takes into account nature of the accounting estimate and whether the information is would be relevant to identify. Like what type of estimates you will ask. Will you ask every estimate's pre-period experience? No. And everything do you check in detail? No. So what is that you are going to pick? How much extent you are going to verify? That depends upon how much it's going to help you in identifying, assessing the risk of misstatements. And the purpose is not to question the judgments of the management. The outcome of the period will differ often. The auditor may obtain information about the effectiveness of the management process, evidence that is pertinent to re-estimation, and evidence. See, why this is required? Because by doing this review, because this part of the thing is not there in your study material. Please see, these 3 points are not given in your study material. Why this review is required? Because it will help to know effectiveness of the management's estimation process. If any re-estimations are done, you will come to know is there any re-estimations required, and it will give evidence about the estimation uncertainty which has to be disclosed in the financial statement. So primarily here, what is the use of such prepared? Yes, I hope it's clear, student. And the review of prepared estimates may assist to identify the possibility of the management bias. The auditor's professional skepticism identify the such circumstances, determining the nature extent of further procedures. The management is not correct. Yeah, one element, students, we have to include this because this part is coming only in your test your knowledge. Which one? The reason why the review has to be done. But if you go back to the study material, they have not told you. See, only one para has been given. Okay, so we'll move on. The second one, see, they have given the heading called estimation uncertainty. I want you to strike that heading, students. Let us write a proper heading when you are reading. The second step should be identify and assess ROI, which they told in the next para. See, they are given in the box. So they are trying to create a confusion. But you be very clear. What should be the step? So once you have performed the risk assessment procedures, your next job is to identify the risk. What is risk for you? Any estimation having high degree of estimation uncertainty is the risk. So once you have performed risk assessment procedure, you should evaluate the degree of estimation uncertainty associated with the estimate and check is there any single estimate which is very significant risk. That means estimation uncertainty is very high. This is what you need to do. Okay. Now, actually, they should have discussed all these elements. Like, what do you mean by estimation uncertainty? Why it vary from organization to organization? Why for some items the estimation uncertainty is very high, for some it is low? Okay. What all? You have seen, no? So many factors. They should have discussed it here. Next, respond to the assessed risk of misstatement. Point number 3. You please make a change. Okay. You have to write like this only. Otherwise, you will not be able to understand. So the heading what they have given is estimation uncertainty, and the content what they have given is about the response. And they have to respond to the assessed risk of misstatement. Let us go to the next page, friends. First, let us complete this, and then we will go to the exam. See, that's why they have asked in the exam. See, they will create a confusion here, and then they start asking in the examination question. Now, let us have a very good clarity. So, my second step is to identify and assess the ROMM. So, in identifying and assessing ROMM, I need to evaluate the degree of estimation uncertainty and see which estimation uncertainty will give to significant risk. Same points we have written. Third, we need to respond to the assessed risk of material misstatement. Now, what is that response we need to give? See, there are two types of responses we need to give. First of all, when we have assessed estimation uncertainty, one, normal estimates, another, estimates with the significant risk. So, there are two types of responses we have to give. One is very general response. Based on the assessed ROMM, auditor shall check whether management has appropriately applied a financial reporting framework. If the FRF has told, do fair valuation at FVTPL, have you done that? First thing you need to check, have you complied with the financial reporting framework? Very first question. If your Companies Act has told depreciation has to be charged for the life of 25 years, have you complied that? Or have you considered 30 years? The very first thing is, have you properly applied the reporting framework? Okay. Second, whatever methods you have adopted to make the accounting estimates are appropriate and applied consistently, like LIFO, FIFO, discounted cash flow method. These are all the methods. Way to calculate. Is it appropriate? Is it acceptable in the industry? Is it acceptable to the financial reporting framework? And have you been doing it consistently from last year? If there is any change in the estimates or in the methods used from making paper, are those appropriate in the circumstances? Like sometimes no, you may shift yourself from FIFO to weighted average method. What is the reason? Is it appropriate? How do you judge? What do you mean by an appropriateness? Okay, I can give you an example like this. Why shifting from FIFO? Because FIFO is the method of estimation. To weighted average is also a method of estimation. When FIFO to weighted average is more appropriate. Like for example, students, you understand, I am a business into doing some activities. Now there is something called an industry. In the industry, there are similar businesses who are my competitors. Now, all these people are following weighted average method and I am using FIFO method. Is there any problem? Absolutely no problem. Now, I want to list myself into NSE. Now, NSE, the moment I want to list myself, my shares has to be valued now. Share valuation has to happen. And one of the famous method for share valuation is price earning ratio. So you will take the P ratio of your competitor or the market leader in your industry, and accordingly you will try to see the valuation, how much EBITDA you have earned and all, which you are learning in AFM. Now there is one catch here. When I talk about the earning, this earning of my competitors are decided using weighted average method. But my earning is decided using FIFO method. Now investors may find it very difficult to compare this because this requires an adjustment. So in order to align with my industry practice, since I am planning to come with an IPO, I may decide to change in the method of my estimate. And is that appropriate? Yes, it is appropriate, and that's what the auditor need to verify. I hope it's very clear. So when you talk about how do you respond, first you need to check whether have you complied with FRF, whether the method is appropriate and consistent, and any change in the method or estimate are appropriate. Okay, and in response to the assessed ROMM, you need to determine whether the events occurring up to the auditor's report provide evidence. That means when this estimation was done on 31st March 2026. Now, when you are signing your audit report on say 18th of May 2026. Now, there can be so many instances where between this time, you got a better clarity. Like fire happened on 31st March. They made an estimation of the loss. But by 10th of May, the insurance company has given a very clear-cut picture on whether they are going to approve or they are not going to approve. That's why you have to consider or any events which occurred up to the date of auditor's report, whether it is giving evidence about that. Test check some of the data used by the management. Evaluate whether the method used is appropriate in the circumstance. In line with the I can say it's the same point. Consider the source, relevance, or reliability of the external data on which they have calculated. Recalculate some of the accounting estimates. That means what depreciation they have done, you recalculate and check. Test check the effectiveness of the internal controls, because who is doing that, whether the expert is doing, internal people are doing, you check the effectiveness of the control. And consider, do you need any specialized skills or knowledge? Okay, we can write all this as a single point, students. What is your response to that? This has to be applied for all clients, whether you have got significant risk or you don't have significant risk. Now one question comes. If you identify any estimate having high degree of estimation uncertainty, then that is a significant risk. So if you are identifying anything as a significant risk for which auditor has to pay more attention, are you supposed to do any procedure? These are all general procedures. I can say this is general procedure. This is you are going to perform for everyone to identify the risk and assess the risk. Now, are you supposed to perform anything extra if you identify a significant risk? Yes, let us go back. This is what you need to write. So, besides above, in addition to other substantive procedures, what you are going to do, so auditor shall perform below things. Like I can give you an example, students. Now, management is routinely doing tax provision, they are doing litigations, they are doing so many types of like warranty provision, fair value, FETPL, so many things they are doing. Agree? Now, say for example, I can take the example of your idea, right? Hutch, I believe. The dog was there. Wherever you go, it will follow. Okay, there is one very famous incident happened with this Hutchison SR or something. Okay, I'm not recollecting the exact name, which company sold to whom. I'll just give the gist of the case, what happened. Please understand. Let us take Hutch only for time being. I'm not sure about whether it is a Hutch or some other company. See, Hutch had the mobile phone operations in India. Okay, it had all the network, everything. It was giving service. Now, the owners of Hutch are belonging to another country here. Now, what they did, they saw some provisions in the Act, Indian Income Tax Act 1961. Okay, probably they must have taken clarity also. Now, the owner who is sitting in, say, for example, UK, sold property which is located in India to another person who is located in, say, for example, France. Now, he is a non-NRI, he is non-resident. This person is also non-resident. So, this transaction happened between two foreigners actually. But that transaction subject matter is located in India. And at that time, there was a provision, okay, that, okay, some tax, there was some loophole. That's why, no, there was no tax. Now, what happened? No, this Indian Income Tax Department served a notice on the seller. And they said there is a capital gain tax applicable here. So you should have deducted some TDS, something, some provisions. Okay, I have not gone through the case. And you know the amount of demand involved. It is rupees 11,000 crore rupees. Can you believe, students? And this matter was taken up by one lawyer called Harish Salve, who is a CA cum LLB. Now he fought and successfully told, no, this one, you cannot raise the demand like this because of these provisions. And Government of India amended Income Tax Act with the retrospective effect, and then they have served one more notice. Now what I'm trying to tell, if you see, there's one big amount of litigation now, and amount of estimation uncertainty is very high now. 11,000 crore. If something goes wrong, you may have to pay 11,000 crore. So tell me, students, that year, is it not a very significant item for the auditor? Because any small estimation changes happen, no, your financial statement will have a very big material misstatement. The auditor should have extremely worked hard on this particular element. So now if you find any such type of significant risks in your financial statement which is related to estimation, how do you do it? What are the additional procedures you need to perform? Okay, first you need to see, has the management considered alternative assumptions or outcomes and why it rejected, how management otherwise addressed the estimation uncertainty. You see, student, more than auditor, this is the headache of the management now. Followed, no? So now what auditor should ask, how did you address this? Have you considered alternative provisions? Have you taken the advice consultation, or have you gone for arbitration? So have you thought about these alternative assumptions and the outcomes? Now whatever significant assumptions you have made, whether to make provision or not to make the provision, are they reasonable? And whether the relevance and relevant to the reasonableness of the assumptions used by the management, whether the management has got intention to carry out specific courses and ability to do it. Like for example, management has given you an assurance, no sir, we need not make provision because we are going for arbitration. Okay, does you really want to go for arbitration? Then I will say, show me the arbitration application. Or can you really go for arbitration under Income Tax Act? Is there any provision that you could have gone for arbitration? Like this type of questions you are going to ask to the management, because these are all substantive procedures for significant risk. Let us see how they are going to ask the examination question. And if in the auditor's judgment, management has not adequately addressed the estimation under uncertainty, you may have to develop a range. Now you may have to talk to your own expert and see what may be the amount of provision they may have to make against this 11,000 crore rupees. So you may have to develop your own and check whether for accounting estimate that gives to raise to significant risk, obtain following sufficient evidence, appropriate evidence, whether management's decision to recognize or not to recognize and what measurement basis they have selected are as per reporting framework. Okay, so if the management decided not to recognize the provision for the legal suit, like say rupees 11,000 crore, have you complied with Ind AS 37? What Ind AS 37 is telling? What all the guidelines they have given? Okay, so if you decided to make a provision, have you complied with Ind AS 37? Whatever Ind AS 27 has told, have you followed it? This is what you need to follow. You see, students, this is a very tricky, bit confusing. Okay, but this is how what they have asked in the examination question. Let us go and check. I hope you are clear. We will make a mind map also so that it will be much more clear before we proceed into step number 4. Let us see one examination question which they have asked. Now, FG and Co. Chartered Accountants have appointed as the statutory auditors of Z Limited during the course while carrying on the risk assessment procedures and related activities related to accounting estimates. Did they tell you which chapter it belongs to? You found out the keyword. Now, engagement partner identified a provision for warranty as accounting estimate. Obviously, provision for warranty is an accounting estimate only. It is not a fair value estimate. And he considered it to be a significant risk. Now, why it is a significant risk? Maybe significant estimation uncertainty, because there are 6 steps of significant risks. In accordance with SA 540, explain the matters that need to be evaluated specifically with respect to estimation uncertainty. In this case, you are supposed to write this, students. This is that. With regard to significant risk, what is that you are going to evaluate? With regard to everyone, these are all the factors you are going to evaluate. This is your response for everyone. So your answer will be, and see how many issues are there. Let us do that practice also, students, because we have been always working like we are seeing so many Q&As. Our first thing what we will look into is clue which chapter. Second, we will look for which concept. And from now onwards, we will develop one new habit. We'll ask one question. How many issues? Is there one issue or multiple issues? Here there is only one issue. Because if you have seen some of the cases, there are multiple issues. Like political party, in chapter number 1, we must have seen the brother was belonging to political party, previous auditor was resigned, income tax rate happened. See, multiple issues they will give in one of the questions, and they may expect us to identify it and accordingly answer. Okay, going forward, we will try to ask one more question to ourselves so that we will have got a very good framework. The moment we look at any questions, okay, these questions we ask ourselves, like which chapter this belongs to, which concept this belongs to, how many issues are there, which verb they have used, are they expecting me to write the standard name, are they expecting me to analyze it or examine it or comment it. Once you go through this type of self question, then any question will, when it passes through, it is clean. Now, you see the answer, how management has considered alternative assumptions, whether significant assumptions are reasonable, relevance to the reasonableness of the assumptions as per the framework, intent to carry out the course of action, and they have got the ability. This is the answer key. In fact, you could have written point number 4, point number 5, point number 6, but the management, they are expecting this is that particular element. See, we don't know, students, what is that we are supposed to write. My suggestion is you write all these 5 points. No. In fact, you start with the what does the essay 540 objective says. You design your answer. You make judgments now. Like which para I may have to write. Okay, here the question was very straightforward. This is what we are going to write. Okay, so now let us continue risk assessment procedures. Okay. What auditor should do? Obtain understanding of FRF, financial reporting framework. Because financial reporting framework requires estimates. Second, understand how management identify how management is going to identify the need for estimate. This is point number 1. This is point number 2. How you will identify the need? You need to have inquiry. Now, what type of inquiry you will make? Okay, point number 1. Any new type of transaction. Second, change in FRF. Financial reporting framework requires you to change anything. Regulatory changes. Does the law require you to have a different type of estimates? Or change in transaction terms. That means you didn't enter into new type of transaction, but existing transactions terms only got changed. Then only you have got an requirement for estimation. In the first case, you totally entered into new transaction, but here existing transactions only got changed. Yes. The third thing you need to understand, how management makes estimates. Makes. This is the keyword here. How do you identify the estimate is the keyword. How management identifies, how he makes. Okay. What all the factors you understand? Again, you inquire about methods, internal controls, use of expert. Have you used experts? See, there's one. There's no point related to outsourcing. That also you can ask, because what management could have done? Management could have outsourced it to third parties. You can ask that also. Have you outsourced? Assumptions. What assumptions you have used? You will ask. Change in methods. Is there any change in method? You will ask management. And sixth element, you ask about the estimation uncertainty. Okay, have you identified any estimation uncertainty? Or how do you identify it? Because for me, it is a significant risk. And the last one, you need to check point number 4. Review, not understand. Huh? All the first 3 are understand. This time review outcome of prior period estimates. First question comes why. Point number 1. Okay, we can write these answers. So we can write not to judge. Not to question the judgments. Objective, why you are doing this? Not to question prior period judgments. Then why you need? If you are not going to question me about the paper judgment, we need it to evaluate effectiveness of estimation process. Then we need to require it for evaluation of the estimation process, like how effective the management's estimation process is. Need for re-estimation. That means if we have already done any estimation in the past, does it require re-estimation now? So by reviewing the prior period, we will come to know now whether this year does it require re-estimation. I hope it's clear. Then the third question, the reason we get evidence about estimation uncertainty. And fifth one, we can say we get evidence on management. So these are all the reasons we need to review the pre-prepared questions. I hope it's very clear, students. So with this review of the mind map book, you will be in a better position to understand it. Yes, I hope you are writing. You are done. Evidence on the management bias. Okay. So the next point here, which you have already discussed, step number 2 is to identify and assess ROMM. So what do you need to do here? Identifying and assessing ROMM, which they have given in the next page. 1. Evaluate degree of estimation uncertainty. Second, identify significant risk. Check whether any of the estimate is giving significant risk. Okay, next question comes. What is your response? You have identified the risk and assessed the risk. What is your response now? Okay, so my responses I can list it like this. 1. Whether FRF, financial reporting framework, appropriately applied. Okay, have you applied the financial reporting framework appropriately? Method is appropriate and consistent from last year. Changes are appropriate in present circumstance. I explained you when it is going to become appropriate in present circumstance. We can write further. Instead of ABC, we can continue here. I can say if subsequent events up to auditor's report. You need to check the subsequent events up to the date of auditor's report. Test check data. Recalculate effectiveness of internal control. So these are all the procedures you need to consider. And last one you can write consider need for expert. Yeah, because generally in the estimation, no, we may require an expert. So consider the need for an expert. So this is what you are supposed to do as part of the response to the risk. I can say there are 7 activities you have to do. Now one question comes, what if you have got significant risk? What is your response? These are all the normal responses. Okay, check whether expert is required, recalculate, test the source data, whether the method is appropriate, change is appropriate. In such cases, our procedures are different. Alternative assumptions. You check whether management has considered alternative assumptions. And they have taken reasonable assumptions. Because assumptions play a very important role in every estimate. What you are assuming, what you are expecting. intention and ability to carry specific course of action. You see, students, estimation is so beautiful, right? Like, you also do a lot of estimations, like I will complete this work by so much, I will complete that by so much, I will read by so much. See, when you make a plan, okay, there should not be too much difference. That's too much uncertainty. Because too much uncertainty is my problem actually. This is what we have to try to figure out. Now, fourth thing, develop range estimate. If the management has not adequately addressed the risk of estimation uncertainty, auditor has to develop the range estimate. You say recognition and measurement criteria. That means whatever your standards have told with related to the significant risk are compliance with the recognition and measurement criteria. Yes, done. So you see, this is the most confusing part in this particular chapter. But if you go through these notes, it's very easy, right? First, you need to perform a risk assessment procedure. It includes 4 elements. So you're going to ask certain set of questions. Okay, again, I am making of the process, and you do some pre-prepared items. Why? Done. Second, you have to identify and assess what you are doing, estimation of uncertainty, and identifying significant risk. What is your response? You have got one normal response, and if you have significant risk, these are all the additional responses. And now the fourth requirement is to evaluate reasonableness of estimate. I don't want to tell anything here, there is nothing. So you are going to check whether the estimates made are reasonable. Okay, now fifth is bit important, reporting and disclosure. And I hope students you have seen that connection between one step and the other step. You cannot come to reporting unless all the 4 you have completed. You have to document all these things. Now, what is this reporting and disclosure? First thing, students, when management is making estimates, as per accounting standard, as per Ind AS, they have to do disclosures in the notes to accounts. Now, what type of disclosures? There are 2 types of disclosures. One called the basic disclosure. What does the basic disclosure include? Okay, what is this estimation all about? What assumptions they have taken? Why they have selected the basis of selection of the estimate? Why they selected one particular method? Is there any change? Okay, and estimation uncertainty is there or not? So this is what you need to disclose. And in respect of significant risk, okay, this is the basic significant risk. So management should tell that there is a significant risk. This is what the management has to disclose. Okay, so auditor need to evaluate the same. Let us see now in the study material what they are telling. Okay, evaluation of the reasonableness of the accounting estimates and estimate. Auditor shall evaluate the accounting estimates. You obtain the evidence. Now, what is the disclosure related to the estimates? The auditor shall obtain the sufficient evidence, appropriate evidence, whether the disclosure in the financial reporting framework, financial statements according related to the estimates are as per applicable reporting framework. And if it is giving rise to significant risk, auditor shall evaluate the adequacy of the disclosure in the context of applicable reporting framework. So what is the basic disclosure every organization should do? The presentation of the financial statement in accordance with the applicable shall disclose assumptions used, what is the method of estimation, How did they calculate that? What is the basis of selection of that method? Is there any change in the estimation from the prior period? And the sources and implication of the estimation uncertainty. These are all the basic disclosures. Please mark it very important because there is no questions on this, but they can ask you because this is sitting in a box. Now, who should make this disclosure? The management. Now, disclosures of significant risk in relation to accounting estimate having significant risk, even where the disclosures are in accordance with the applicable reporting framework, auditor may conclude disclosures of estimation uncertainty is inadequate. Okay, so yeah, they have to check, evaluate the adequacy of the disclosure. So what the organization should do, they have to disclose that there is material uncertainty. Okay, so auditor may have to evaluate, have they sufficiently told that, okay, coming back to case that Hutch case, rupees 11,000 crore is in litigation. Is it a significant risk? Absolutely yes. But the management can write only one line somewhere in note number 26. No. You understand here? So they may tell method of assumption, everything, but they may not tell the fact to someone that there is a high estimation uncertainty. It's a very significant risk. So auditor may have to go through the notes to account, see how they have disclosed it. Are they sensitizing it appropriately? Does the user can understand what they are trying to tell? If no, then you may have to qualify your report. Now, written representation, you have to obtain a written representation that all the disclosures are appropriate, whether they are believing sufficient assumptions, significant assumptions are reasonable, because they only have to tell. Let us see one model test paper questions. This question came in your model test paper. Now, statutory auditor, which came in November 19 exam, requested management for written representation in respect of obsolescence of inventory and warranty obligations recognized in the financial statements. Okay, so written representation would have taken you to SA 580, but this is in the intermediate. In final, they have not discussed only. But when you see this word called a warranty obligations, somewhere you should strike that they must be asking this question from 540 perspective. Let's see. The manager denied the representation on the ground that during the course of the audit, all required procedures are performed with the auditor. And after obtaining sufficient evidence, auditor has issued a clean opinion also. Then why you are asking this? First of all, there is a lapse. You cannot issue the opinion unless you have obtained the written representation. That you have to tell. There is a clear-cut lapse. And the auditor can take representation for any of the assertions. SA 580 says that. Okay, so he has to take that representation. Again, in exam, while conducting the audit, substantial amount is recognized in respect of obsolescence inventory. Want to obtain the representation about the assumptions and estimates used in reasonable. See, very clear cut guide. But in this model test paper, you will not come to know which chapter it is. Anyhow, we have understood now. So you talk about say 540 that you have to obtain representation from the management about the significant assumption. And see, now they are speaking about 580. What they have discussed at the interval. That's why I marked it important, because 580 has not been discussed in the final study material, but 580 related points they have given in the material. So this becomes part of your syllabus now. So the written representation discusses the use of representation depending upon the nature, materiality, etc. And it shall include representation about the appropriateness of measurement process, consistency application, assumptions reflect management's intent and ability, disclosures related to the estimates are complete and appropriate, and there are no subsequent events. Okay, so what is that representation you need to take? You need to take that representation about estimates. These are all the 4 points. So since they have not given this in the study material, I have marked it as important. So it is the appropriateness of the measurement process. That means whatever method process you have followed, that is appropriate. You have consistently applied. Your assumptions reflect that you have got intention and ability to carry out. And all the disclosures related to estimates are complete. Nothing you have left out. And there are no subsequent events which have occurred which are not brought to our notice. Okay, so these are all the 4 representation you take. So management contention is not correct. Written representation has to be taken. Auditor shall discuss it, reevaluate the integrity, and take appropriate action. And where is this answer? This answer is in SA 580. Please understand, this written representation discusses the use of representation, full stop. This particular portion is coming from 540 only. If you open the bare standard, from here is part of your SA 540. Only one statement they wrote. And this particular portion is coming from 580. So once you know which portion comes from where, your answers are very easy. So you are guiding what if the management is not going to give you representation? What if they are not going to provide you representation? What you should do? Maybe 1 mark must have been allocating for any of the points. I believe majority of the marks will be distributed for this. At least 3 marks will be given to write this particular points. I hope it's clear. And the last is your documentation. The audit documentation shall include basis of the auditor's conclusion about the reasonableness if any indicators of management bias is existing. Friends, so audit documentation is very easy. Let us go for the mind map. Disclosures and reporting. Okay, let me just see in the okay. So we will write here reporting and disclosures. So what are the basic disclosures should be there? So we can write evaluate. See, up to here you have evaluated reasonableness of the estimate. With this, your objective number 1 is complete. What is your objective number 1? Whether the estimates are reasonable. What is your objective number 2? Whether adequate disclosures are done. Now you need to check evaluate adequacy of disclosure. Now there are 2 types of disclosure which a management is supposed to do. Basic disclosures. What are all those? Assumptions. Then method. Then basis for selection of method. Changes in the method, if any. Source and implication. From which source that estimation uncertainty is coming, and implication of estimation uncertainty. Source and implication of estimation uncertainty. Not about the significant risk. This is basic disclosure. Adequate disclosure of estimation uncertainty. Because significant risk comes because of high estimation uncertainty. You have to check adequate disclosure of estimation uncertainty. Adequate disclosure of estimation. The 6th one, obtain written representation. Okay, what related to which matter? 1. Okay, we will write it from the Q&A. Appropriate method. The method what they have selected is appropriate in the given circumstance. intention to carry out significant assumptions. Okay, so here I can say intention and ability to carry out significant assumptions revealed all subsequent events. You have revealed all subsequent events. And the fourth one is the last one. Disclosures are complete. That means there's nothing more now. Disclosures are complete. See, these points are missing. And you know how they presented it as if it is essay 580 points. No, they are not essay 580 points, they are essay 540 points only. Essay 580 points are what if the auditor management do not give representation? Then you should say we will even evaluate their integrity, we will modify the opinion, we will consider withdrawal from the engagement. This is what you are going to write. Point number 7, documentation. Reasonableness of estimates, whether they are reasonable, and whether any management bias has been identified. Okay, only two things you are going to document: whether the estimates are reasonable, what is your conclusion about it, and whether they have found out any indicators of management bias. Yes, students. So with this, we are done with almost done with the third chapter, because there are no more questions. 520 they have not asked a question, because in detail they have discussed 520 in the intermediate level. The next para they speak about quality control of the audit work. I don't know why they are speaking at this point of time. Under SQC1, you need to maintain a quality control system that gives the firm and personal, and reports are appropriate. They spoke about the objective. They have got a responsibility to implement the quality control procedures, and they are working. Engagement teams are entitled to rely on the quality control. SA 220 deals with the individual engagement level, and their objective is so. So this is the objective of SA 220. I don't know why they spoke about the objective here at this point of time, and they said refer chapter 1. So you ignore this. We have already studied in detail in chapter 1. Then they said one para about analytical procedures prior to audit as well as during the finalization, and performing substantive analytical procedures. Okay, at this point of time, students, I want to tell you something on the concept of analytical procedures and how it is different from substantive analytical procedure. In the interview, you must have known about it. Okay, very importantly, what is analysis? We already discussed. Analysis means you have got one big portion. It will have certain set of components, or I can say multiple issues. Now, you understand every single component and try to establish a relationship between one component and the other component. You try to see this relationship. Okay, that is analysis. What is the examination? In examine, the whole big part is broken into pieces, multiple issues. You pick one issue and go more deeper into it. That is examination. I hope you are clear about the concept of, because in some examination question they say analyze, and some question they say examine. In examine, you may have only one issue. You have to go more deeper into it. In analyze, you may have multiple issues. You have to figure out the relationship. Now, this comparison and figuring out the relationship is called analysis. So, when you talk about the relationship, there should be two elements. two set of data, data 1, data 2. Now what is analytics? See students, if this relationship has been already figured out, every relationship is figured out with the question of why. Why is such a beautiful question? You always ask. Okay, like Newton asked, why apple is falling? Very beautiful question. You see, he came with something totally different. Very simple question. Huh? Have you ever, have we, are you including me also, have we ever asked in our life why sky is blue? We never asked that question. But C.V. Raman asked, and he got Nobel Award for that question because he found out. See, it's not simply asking question why. Somebody becomes so curious and start pursuing that why, no? It takes them somewhere else. So when you ask one question which no one asked, when you ask, try to compare debtors turnover ratio with the inventory turnover ratio. The first time you ask this question, is there any relationship between them? That is called analytics. Analysis means somebody has already done that. It is your knowledge. You are repeating that. Analytics means nobody has done it in the past. First time somebody asked a question, is there any relationship between this? This is called analytics. So are we talking about analysis procedure or analytical procedure? We are talking about analytical procedure. That means you as an auditor should try to identify and ask some new questions. Try to figure out a relationship. So this can help you to identify a risk. Now, how it is different from substantive analytical procedures? See, when you are performing risk assessment procedure, you can perform some analytical procedures like comparing trend, pattern, comparing your gross profit with industry gross profits. They are all your risk assessment procedures. Okay. So your gross profit is 5%, industry gross profit is 6%. Will you say your P&L account is true and fair? You will not say no. But with this, no, you know that, okay, risk of misstatement is low because they are matching with the industry. In substantive analytical procedure, what happens, students? You see, it is substantive. That means it is a additional independent work you have done. Like, for example, you have verified gross sales. You have verified sales. Now, you know that there is only one item and its applicable GST is 18%. In the P&L or balance sheet, you multiply sales into 18%. And you figure out the number. Are you not going to sign GST is true and fair? Or rent is 10,000 rupees per month. You have occupied the building for 12 months into 12. Is it not that 1,20,000 should be there in your P&L as rent expenses? At the moment you see this amount, you will go and sign. You will never watch, you will never verify, you will never do external confirmation. This is a procedure where with the relationship you certified the balance sheet or the P&L, no? This is called a substantive analytical procedures. I hope you are clear about this concept. Now, as per 520, analytical procedures, auditor shall determine the suitability of a particular substantive analytical procedure for the given assertions, taking into account the risk of misstatement, test of details, if any, evaluate the reliability of the data based on which expectations will be developed, develop an expectation, determine the amount of any difference. Okay. First you see, you want to certify the rent expense. Now, if you perform substantive analytical procedure, please see the word they have used, determine the suitability of substantive analytical procedure. They didn't say analytical procedure. That means they are talking about the audit part. That means what did you do? How did you certify? 12 months into 10,000 rupees. Now you tell me, students, did it give you evidence about all the assertions like completeness, rights and obligation, completeness, occurrence, value, accuracy, cutoff, and your classification? Yes, your one procedure gave you evidence about all the 5. Now, is that suitable? Are you going to leave something out? Like, for example, your last year, I can give you one more example. Last year, your sales was 100, stock was 10. That means it is 10%. This year, means generally it is 10%. This year, your stock is 120. So how much you expect in the balance sheet at the end of the year? Say 112 rupees is what you're expecting, correct? And when you go and check the balance sheet or you go see and check the P&L account, yes, closing stock is 12. Now tell me, students, how did you audit this closing stock? By performing the substantive procedure. What is that? Sales into 10%. Because this is the industry standard, let us assume. But tell me, which evidence it gave for which assertion? It gave assurance, evidence only for accuracy, not existence. Because this closing stock may not be existing there. For this, you have to do perform physical verification. This is what they say. First thing, you need to check whether that substantive analytical procedure is suitable for the given assertion. Second, from where did you get that sales data? Is it reliable? Okay. Is it comparable? Can you trust that source data? Because if the data itself is wrong, then your calculations are wrong. Then once your data is correct, if you are meeting your expectations, then develop an expected amount. So you multiply or you do one model and see how much should be the amount which should be coming and check if there is any difference. So this is what you're supposed to do. There is no question. Purely intermediate related content. Analytical procedures that assist in when forming opinions. So at the end of the year, auditor shall design and perform which procedures? Analytical procedures, not substantive analytical procedure. At the end of the audit, whether while forming overall conclusion, whether they are as per understanding. That means check again gross profit percentage, debtors turnover ratio, fixed asset turnover ratio. So many ratios you compare, check the trend. So that overall level, are you okay? So the conclusions drawn from the results of analytical procedures are intended to verify the conclusions formed, whether your auditor's opinion is reasonable. The results of analytical procedure may identify a previously unrecognized risk of misstatement. That means suddenly you may figure out something which was never identified. So this is what you need to perform as per SA 520. And third step, you have to do the investigation of the results. If you identify any fluctuations, any variations, you have to do the investigation by inquiry of the management and performing other audit procedure. Like suddenly you see that there is a 8%, okay, from 750, you see 1000 crore is the turnover. That means 33% hike without change in the plant and machinery capacity. What you should do now? Because this is an unexpected relationship. You never expected. It is inconsistent with your expectation. First you ask management, sir, what happened? Then management will give some explanation. So don't simply accept that explanation. Perform audit procedure. If they say that, sir, we have purchased from the third party, we have never manufactured it. Okay, you see, is there any purchases cost has increased? It is possible. No, your plant capacity never increased. But it is highly possible you could have purchased it from other plants directly, FG, and you could have sold it. So gather that other evidences and see whether they are adequate. Management response is proper. Yes, students, with this, we are done with the chapter number 3, a very heavy chapter. Just hope from next chapters onwards, we will not be spending this much of time. Yeah, because bit simple. Chapter number 4 is the risk assessment related internal control. Already you have studied at the intermediate level. Everything you have studied at the intermediate level. Chapter number 4. Chapter 5, 6, only charts they have given. So I told you our next stop will be chapter number 7, which is very important. Yes, thank you. So we'll continue tomorrow, students.